Welcome back to the Deep Dive, where we take a stack of dense sources, corporate filings, financial histories, and legal reviews, and extract the most essential, surprising knowledge, delivering the shortcut to being well-informed just for you. Today, we are zeroing in on a company that represents an absolute mastery of corporate reinvention. It's a massive enterprise that touches many aspects of your modern life. It might be the quiet financial force behind the protection plan on your smartphone, or the insurance coverage on your rented apartment, or even the mechanism that guarantees your mortgage lender's security. Yet, despite its scale, it's a name, Assurant Inc., that often operates just beneath the surface of public awareness. Our mission today is a true deep dive. We are going to unpack sources that trace this company's remarkable 130-year journey, charting its course from a tiny mutual aid society to its current colossal scale. We are talking $11.9 billion in revenue in 2024. And crucially, we are dissecting its strategic transformation away from being a sprawling traditional insurance conglomerate and into a global, highly specialized niche market protection provider.
Well, when we look at Assurant, or AIZ, on the New York Stock Exchange, we are examining a truly complex global provider of specialized risk management products and services. What's fascinating here is that this isn't just the story of success. It's a definitive case study in corporate evolution driven by necessity and strategy. They went from being a multifaceted conglomerate back when they operated under the Fortis banner to the highly focused specialist they are today, a firm that is, stable enough to be a component of the S&P 500 index.
Which is saying something.
It really is, and their operational scale justifies this analysis. As you noted, the financial metrics are huge for a company specializing in such narrow fields. Their 2024 filings show $35 billion in total assets and a global workforce of 14,200 employees. This is a financial behemoth that has quietly redefined what it means to be an insurance company by specializing in specific points of consumer and financial risk rather than trying to cover everything.
Precisely. And in this deep dive, we're going to trace this lineage, which is complex and full of mergers and divestitures. We'll trace its roots way back to 1892 in Wisconsin, dissect the two massive modern operating segments that define its business today, global housing and global lifestyle, and discuss the truly pivotal, radical strategic shift it made starting in 2015. But to understand the brilliance of that pivot, we cannot ignore the historical headwinds. We have to dedicate substantial time to examining the controversial history of its former health division, a history involving massive punitive damage awards and significant state fines that ultimately drove the company to shed that entire profitable segment. Okay, let's unpack this journey, starting right at the beginning. To understand the specialization of Assurant today, we have to appreciate just how much it has changed. This is not a Silicon Valley story. We're beginning this narrative in the early 1890s, specifically 1892, in La Crosse, Wisconsin.
That founding identity is critical because it gives us insight into the original purpose of insurance. It began as the La Crosse Mutual Aid Association. The original concept was purely regional and focused on the immediate need for security in the burgeoning industrial Midwest, selling disability insurance.
Right.
This was classic mutual aid, a group of people pooling resources to protect against a common immediate risk disability due to industrial accident or illness. It was a very far cry from managing the global logistics of device protection. That original entity, the La Crosse Mutual Aid Association, would later be known as the Time Insurance Company.
And for nearly a century, that company operated regionally, adapting slowly. But the late 1970s marked the end of that independence and the sharp transition from a regional American company into a massive international conglomerate, thanks to the influx of European financial muscle.
That's the era of conglomeration, and it starts with the Dutch influence. The first critical strategic pivot came in 1978 when NV-AMEV of the Netherlands acquired the Time Insurance Company.
And they did this through a U.S. holding company.
Yes, through its U.S. holding company, AMEV Holdings, Inc. This acquisition wasn't about specialized growth, it was about market entry and diversification for a large European player looking to expand its footprint in the lucrative but fragmented U.S. insurance market.
So AMEV Holdings, Inc., becomes the U.S. vehicle for expansion. What followed was an incredibly aggressive 12-year acquisition spree, running from 1978 to 1990, where AMEV Holdings, Inc. rapidly expanded its portfolio. This period defines them as a generalist.
Indeed. Think of this phase as aggressive financial engineering, designed to capture market share across every possible insurance niche, regardless of whether those niches had operational synergy.
So they were just buying up everything.
Pretty much. We see them acquiring American Security Insurance, which was heavily specialized in credit-related insurance tied to loans and financing. They also picked up United Family, which focused on funeral insurance, a highly specialized, predictable niche.
And it didn't stop there.
Not at all. They acquired Western Insurance Company, which brought in entirely new competencies, specifically mutual funds and investment management. And finally, they bought Superior Insurance, entering the highly competitive and volatile auto insurance market. This expansion shows a very broad, almost indiscriminate approach to risk management, essentially building a sprawling insurance empire under one umbrella.
It sounds less like a defined strategy and more like assembling a diverse financial arsenal.
Yeah.
But the corporate identity itself fundamentally changes in 1990 with the creation of Fortis, tying the American operations even more closely to a European banking model.
This is the definitive step toward the conglomerate model. In 1990, NV-AMEV of the Netherlands acquired VSB Group NV Bank. This move was revolutionary in the Netherlands.
Why was that so significant?
It created Fortis, which became the Netherlands' first major financial conglomerate that successfully combined the operations of a major insurer and a major bank. This was the vision of integrated financial services synergies between lending, investing, and risk protection.
And the American operation quickly absorbed this new global identity. AMEV Holdings, Inc. was rebranded Fortis, Inc. in 1991. Now operating under the banner of a major bank insurer, the expansion became even more targeted toward traditional financial services. They acquired the group life, accident, and health insurance lines from Mutual Benefit Life Insurance Company in 1991, significantly boosting their exposure to complex health and life risk.
And the 1990s became a period of rationalization, still buying, but also trying to define the core. They sold off some of those earlier, less related acquisitions like Superior Insurance in 1996, exiting the competitive general auto market.
But they kept buying too.
Oh, yes.
Huh.
But they also made key purchases that would define their future problems and successes, acquiring John Alden in 1998, which specialized in individual health insurance. That's a critical link to the later scandals we'll discuss.
Okay.
And they acquired American Bankers Insurance in 1999, which focused heavily on specialty finance-related insurance like collateral protection.
Wait, I want to pause on that John Alden acquisition in 1998. Since we know where this story goes, that acquisition seems like the moment they dramatically increased their exposure to the type of volatile major medical risk that they would later spend billions to exit.
That's a crucial observation. The John Alden acquisition was highly strategic at the time, positioning Fortis as a major player in individual and group health. However, as the U.S. health system became more complex and regulated, particularly regarding pre-existing conditions and policy rescissions, the very topic of our later segment, that acquisition became a ticking time bomb of legal and regulatory exposure.
So that was the moment.
It was the moment they embraced complexity that would later nearly sink the ship.
And continuing the churn, even after these major acquisitions, they sold their core life insurance business to the Hartford in 2001. You can see the constant attempts to define their core business, but they were still a mixed bag.
Which brings us to the absolutely critical moment in 2004, the moment the American entity steps out of the massive Fortis conglomerate and gains its current independent identity, the spinoff and rebirth as Assurant.
Why did Fortis decide to separate the U.S. business entirely in 2004? Was this purely strategic, or were there problems in the conglomerate model?
Well, the conglomerate model, particularly combining banking and insurance, was falling out of favor globally, and the U.S. operations were often seen as a separate, complex regulatory environment. Fortis decided that its American business needed focus. So Fortis's American business was renamed Assurant and was formally spun off from the parent company, Fortis Insurance NV, in 2004.
It was about clarity then.
Exactly. This separation was about achieving clarity, focusing capital, and addressing market skepticism about the complexity of the combined entity. The significance of the initial public offering, or IPO, cannot be overstated because it firmly established Assurant as a major independent public entity with its own defined strategy, distinct from its European parent.
It truly redefined their scale and independence. The IPO happened on February 5, 2004, and the valuation was enormous for a specialist. The IPO value came in at $1.76 billion, making it the fourth largest IPO of that entire year. And in connection with this public offering, that's when the company formally changed its name to Assurant, Inc., solidifying its name and its new public identity on the New York Stock Exchange under the ticker AIZ.
So, in just over a century, we've gone from a regional mutual aid group protecting against disability to a separate, publicly traded, multi-billion-dollar entity emerging from the shell of a massive European financial giant.
An incredible trajectory.
This trajectory confirms that Assurant has consistently adapted and shed pieces of his past to survive.
Let's ground this in the present. Just how big is this newly specialized company today now that it's been operating under the AIZ banner for 2 decades?
It remains a financial powerhouse. As of 2022, based purely on revenue, the company was listed as number 325 on the prestigious Fortune 500 list of the largest companies in the United States.
And the 2024 numbers.
To reiterate the 2024 financials, the company reported US $11.9 billion in revenue and holds $35.0 billion in total assets. This cements its role as a central, major player in the global financial services sector, even if its specialization makes it less of a household name than a MetLife or a State Farm.
It's the definition of an invisible financial giant. That sets the stage beautifully for segment 2, where we figure out exactly what they specialize in now, having shed that generalist approach.
The crucial element of the modern Assurant is its laser focus. They operate today through 2 core segments, focusing almost exclusively on specialty, niche market insurance products rather than broad, general coverage. This strategic choice is what defines their profitability and their reduced regulatory volatility.
That distinction between specialty and general is key, and it's where most of the revenue comes from today. Let's start with the global housing segment. We're not talking about simple voluntary homeowners insurance here, are we?
No, we are talking about highly specific types of property risk management, often tied directly to lending and financial institutions. The offerings include traditional property lines like home insurance, renter's insurance, coverage for manufactured housing, and flood insurance. These are complex lines, but their true specialization lies in managing risk for institutions.
Let's dive deep into that institutional focus. The sources highlight lender-placed insurance, or LPI, and mortgage services as the core of this segment. This is a concept that many listeners might never encounter unless something goes wrong with their mortgage.
LPI is a highly important and often controversial niche in the mortgage market. If you have a mortgage, your lender mandates that you maintain property insurance to protect their financial collateral.
That's standard.
It is.
Wow.
But if you, the borrower, let your policy lapse or the lender decides your coverage is inadequate, the lender has the contractual right to unilaterally purchase a policy to protect their interest and then bill the borrower.
And that policy is LPI.
That is lender-placed insurance.
So the lender is effectively acting as the customer of Assurant in this transaction. But the borrower is the one paying the premium, which is almost always much higher than a voluntary policy.
That's the mechanism. Assurant is managing the risk portfolio for mortgage servicers across the country. This means they are responsible for monitoring millions of mortgages to ensure continuous, adequate insurance coverage. When a lapse occurs, Assurant, acting on behalf of the lender, steps in to provide immediate, often costly coverage.
From a business model perspective, what is the strategic appeal of LPI compared to traditional homeowners insurance?
The appeal is stability and control. Traditional homeowners insurance is highly competitive, low margin, and consumer-facing, which means high marketing costs and significant volatility from catastrophic weather events.
LPI is different.
LPI, by contrast, is a B2B relationship. Assurant secures huge long-term contracts with mortgage servicers. The risk models are highly predictable. They know exactly how many policies will lapse in a given quarter. Furthermore, because LPI premiums are non-negotiable for the borrower who has lapsed, the margins can be substantially higher than in the voluntary market.
So it's about volume and predictability.
It's about managing bulk compliance and risk portfolios for large financial institutions, which provides a massive, stable revenue stream.
I see. It's a risk management utility for the financial sector. The global housing segment also includes multifamily housing. How does that fit into this model?
That's another B2B play. Multifamily housing involves managing the risk, often in bulk, for apartment owners and large property management firms. This includes liability, property damage, and often specialized renters' liability coverage bundled into leases.
So again, the institution is the customer.
Again, the customer is the institution, the landlord, not the individual renter, allowing for predictable pricing and streamlined risk administration. This segment is entirely focused on predictable, large-scale property risk management tied to financial services and institutional ownership.
So that's the housing component. All about protecting physical assets tied to massive financial loans. Now let's move to the global lifestyle segment. This is where, as you said earlier, Assurant is right in our pockets and is the most visible to the average consumer.
This segment is a perfect case study in specialized risk in the digital age, and it's the high-growth engine of the company. It's defined by high-volume, relatively low-cost protection products tied to physical goods and services we use every day. And the dominant component here is the massive market of mobile device protection services.
Right.
If you've ever paid $10 to $15 a month to AT&T, Verizon, or a major retailer to protect your new smartphone from being cracked, lost, or water damaged, there is a very high probability that Assurant is the underlying risk carrier or the service provider managing the repair and logistics.
Wait, I need to stop and ask, how does an insurance company become a logistics provider? When my phone breaks, Assurant doesn't just cut me a check. They often manage the repair or replacement. That sounds less like traditional insurance and more like Amazon's supply chain.
That is the core strategic breakthrough of the global lifestyle segment, and it demands operational excellence far beyond what the old Fortis Health division required.
It's a different skill set entirely.
It's not just about paying claims, it's about reverse logistics and service chain management. Assurant has built vast global networks of authorized repair centers, parts suppliers, and reverse flow facilities to handle millions of claims annually. For them, the risk isn't just the cost of a new phone. The risk includes fraud detection, maintaining a stock of specialized refurbished parts, ensuring rapid turnaround times to satisfy the wireless carrier partners, and managing the supply chain volatility of electronics.
They're using data for all this, I assume.
They operate heavily on high-volume transactional data, leveraging machine learning to predict failure rates and manage inventory. They are, in fact, an insurer who became a sophisticated, data-driven logistics company out of necessity.
That dramatically shifts the focus from actuarial science to operational efficiency. And it moves beyond just phones, correct?
Absolutely. They also provide extended service contracts for consumer electronics and appliances. Think of that 5-year warranty you buy on your new high-end refrigerator or your 80-inch television that kicks in after the manufacturer's limited warranty expires.
Another massive market.
Another high-volume, predictable market.
And what are the key partners in this ecosystem? Are they selling these directly, or is this primarily B2B through retailers?
It is overwhelmingly B2B. Assurant partners with wireless carriers, major national retailers like electronic stores and appliance chains, and financial institutions. They are the white label protection engine.
So the customer sees the retailer's brand.
Exactly. The retailer or carrier sells their brand of protection plan, but Assurant handles the underwriting, the logistics, the repair, and the claims. This maintains the specialty model. Focus on underwriting and logistics, let the partners handle the direct consumer sales and marketing. Finally, the segment also includes vehicle protection services, primarily extended mechanical warranties and ancillary coverage, alongside credit and other highly specialized consumer insurance products. It's an enormous segment that touches everything from the financed car in your driveway to the washing machine in your laundry room.
Analyzing the strategic appeal, it becomes clear that these two niche areas, global housing and global lifestyle, share a common DNA: high volume, predictable failure rates, and B2B transactional focus.
They absolutely do. They focus on specific risk types that lend themselves perfectly to statistical modeling and rapid logistical claims processing. This stands in sharp contrast to the complexities of major medical insurance, which they exited.
It's all about managing logistics.
In these specialty segments, they are managing service logistics, repairing phones, replacing appliances, monitoring property, as much as paying out large claims. It's a specialized, quantifiable, and controllable risk environment.
They essentially built a business model around managing the financial anxiety of a consumer society dependent on expensive, fragile technology and leveraged housing. But to achieve this focus, they had to make one of the most significant and painful corporate pivots in their 130-year history. When you look back at Fortis and AMEV, they were heavily invested in traditional life and health insurance, even acquiring entities like John Alden. These lines of business had been a core part of their history for decades. Yet in 2015, Assurant announced a strategic shift so massive it completely redefined the company overnight, prioritizing specialty over tradition.
It was a surgical clean break, executed rapidly. In June 2015, Assurant announced its intention to exit the traditional health insurance marketplace entirely. The strategic objective was explicitly clear: streamline operations and concentrate capital and expertise entirely on their global housing and global lifestyle specialty protection products.
So the Assurant Health business was done.
The Assurant Health business, which had become synonymous with regulatory trouble and legal exposure, had to be wound down.
The process of divestment from Assurant Health was incredibly complex, involving multiple transactions and phases, signaling their absolute commitment to getting out of the major medical space.
Yes, the complexity arose from the varied nature of the health business. The first major indication of the closure was the wind down of the major medical operations. A clear sign of this was their decision not to participate in the next Affordable Care Act, or ACA, open enrollment period, which began in November 2015.
They just stopped taking new customers.
They stopped enrolling new major medical customers, essentially putting the business on life support for the existing customer base. Simultaneously, they were selling off existing supplemental and self-funded lines that were still running. This was rapid financial action. In October 2015, Assurant completed the sale of Assurant Health's existing supplemental and self-funded business lines, which were acquired by National General Holdings Corporation.
And then the remaining financial pieces were cleared out in 2016.
Correct. They handled the cleanup of the financial infrastructure. In March 2016, they sold their health savings account, or HSA assets, and other medical account assets to Select Account. This wrapped up the physical presence of Assurant in the major medical space.
But the exit wasn't limited just to the major health sector. They also simultaneously abandoned the employee benefits marketplace, confirming that the streamlining was comprehensive.
That's a key piece of the pivot. Assurant announced it was exiting the employee benefits marketplace around the same time. This was a significant business line focused on things like group dental, disability, and vision benefits, which requires its own massive administrative infrastructure and regulatory compliance.
And the sale of this entire division was also quick, fetching a high price.
It was. Sun Life Financial agreed to acquire Assurant Employee Benefits for a substantial $940 million in September 2015. That sale, closing in March 2016, mirrored the timeline of the health segment divestiture.
So if we connect this timing to the bigger picture, in roughly 9 to 12 months, Assurant executed a total corporate overhaul, exiting sectors they had been in for 100 years. What was the driving force behind this radical surgical move?
The strategic logic was almost existential. Major medical insurance is fundamentally different from device or housing insurance.
In what way?
It is fraught with extreme regulatory complexity, high overhead, intense legislative uncertainty, especially during the ACA era, and, critically, very high potential for public-facing legal liability and massive punitive damages related to denying care for life-altering illnesses. By exiting both major medical and employee benefits, Assurant completed a transformation into a purely specialized risk manager.
They got out of a messy business.
They moved away from broad, high-overhead segments requiring massive infrastructure and politically charged public engagement, and shifted capital and expertise entirely to the predictable B2B-driven model we dissected in Segment 2. It was a conscious decision to trade regulatory and legal volatility for the more manageable risks of supply chain and asset protection.
It sounds like they built a strategic firewall, protecting their future profits from the baggage of their past. But that past, specifically the health segment they exited, was defined by systemic issues. And we need to dedicate a significant portion of this deep dive to understanding the critical headwinds they faced leading up to that 2015 decision.
This is where we shift focus and apply critical thinking to the narrative. Before the strategic exit, Assurant Health, the very segment they shed, faced significant systemic criticism and major legal action related to policy claim denials and cancellations. This forced the company to reckon with the moral and financial cost of highly complex, high-stakes risk management in the medical field.
The sources provide an alarming overview of findings. Assurant Health was repeatedly found to be systematically canceling health policies for customers who developed serious medical conditions. This practice is known as post-claim underwriting, or rescission, where the insurer retroactively voids a policy, often based on minor application errors, after a major claim has been filed.
Which was a huge problem.
This pattern led to widespread criticism and subsequent fines being levied against the fund by at least 12 states.
And post-claim underwriting is the key legal concept here. In the individual health market prior to the ACA, insurers had much wider latitude to review applications for misstatements after a major claim was filed.
So they could look for any mistake.
If they found any discrepancy, no matter how small or unintentional, they could legally void the policy from its inception. The criticism leveled against Assurant was not just that they did this, but that they did it aggressively and systematically, targeting the most expensive patients.
Let's detail the specifics of how this operated in practice, focusing on two landmark legal cases that highlight the catastrophic financial and reputational damage this practice caused, starting with the South Carolina HIV case, which became public around 2009-2020.
The facts of this case, involving Fortis at the time, are chilling. The South Carolina Supreme Court upheld a verdict that the firm had wrongly revoked the health insurance policy of a policyholder.
And the key detail.
Crucially, the policyholder contracted HIV subsequent to obtaining the policy. The firm attempted to rescind the policy by claiming the patient must have misrepresented their pre-existing condition status, even though the condition developed after coverage began. The initial financial penalty was severe. The court ordered the firm to pay the plaintiff $10 million. But what makes this case so illustrative is the underlying procedure that the court exposed.
What did the court find about the specific internal underwriting policies being used by Fortis?
The findings detailed in the sources are profoundly important for understanding the corporate risk model they were running. The court detailed the internal process of post-claim investigation.
But it wasn't a neutral process.
It appeared to be deployed with malicious intent. The sources, citing Reuters reports on the ruling, revealed that Fortis had a specific documented company policy to target every recently diagnosed HIV-positive policyholder for an automatic fraud investigation as a pretext to rescind their policy. This means the investigation was not a neutral search for fraud. It was a predetermined step to find any possible pretext, however flimsy, to cancel the policy and offload a potentially infinite liability.
That is staggering. Systematically using a mandatory fraud investigation as a routine method to try and cancel coverage for the most critically ill patients, thereby shifting the costs back to the individual.
Exactly. The attempt at rescission in the South Carolina case was based on flimsy or incorrect information, specifically an erroneously dated intake note in the doctor's files.
Just a clerical error.
That incorrect date was forwarded to an underwriter who recommended the policy be voided due to alleged misrepresentation. The broader implication was that policies were being canceled on minimal evidence or for no reason at all, as some reports suggested, simply to reduce long-term medical liabilities.
And what was the final outcome of that judgment? Did the company manage to appeal away the penalty?
No. Fortis attempted a major appeal of this significant ruling, arguing the penalty was excessive. But in March 2010, the U.S. Supreme Court rejected the firm's appeal of the $10 million ruling. This solidified the finding of wrongful revocation and the major financial penalty. It was a massive public and reputational blow directly tied to their internal practices regarding policy rescission.
That case demonstrates the risk of trying to manage complex long-term medical conditions under a traditional insurance model focused on aggressive cost-cutting. But we also have another massive judgment that same year, the 2010 Colorado bad faith judgment, which dealt not with rescission but with outright claim denial following a catastrophe.
This second case highlighted the devastating impact of bad faith claim denial on an individual catastrophe. In February 2010, a jury in Boulder, Colorado, reviewed the case of a woman severely injured in a hit-and-run accident.
And she was covered by Assurant Health.
She was relying entirely on her Assurant Health policy for coverage when she needed it most. The jury found that Assurant Health had breached its contract with her.
And the award here was absolutely staggering, far beyond the cost of her medical care.
Indeed. The jury awarded her $183,551 to cover the medical bills owed, but the punitive damages were where the severity of the jury's judgment was reflected. They awarded her approximately $37.1 million in punitive damages.
We need to pause and explain that figure. Punitive damages are not compensation for loss. They are punishment for egregious misconduct. Why would a jury award an amount over 200 times the actual medical damages?
That is the essential legal question. Punitive damages are meant to send a clear message to the corporation and deter future bad behavior. For the listener, the concept of bad faith in insurance law means the insurer failed to fulfill its legal obligation to the insured with honesty, fairness, and promptness.
So the jury saw intentional misconduct.
The size of that $37.1 million award, described as one of the largest bad faith judgments in Colorado history at the time, signals that the jury believed the company's breach of contract was intentional, reckless, and deserving of severe corporate penalty. These two major cases, the $10 million HIV rescission ruling and the $37.1 million Colorado bad faith judgment, occurred right around 2010. This is just 5 years before the company ultimately decided to shutter the entire health operation.
That context is vital. If we connect the dots, we can see that these systemic legal failures, large state fines, and intense regulatory challenges absolutely predate the company's 2015 decision to divest from the health sector. The health division was becoming an unacceptable corporate liability.
The connection is undeniable. Dealing with major medical claims meant facing constant public scrutiny, intense state regulatory pressure, and the risk of astronomical punitive damage awards tied to human suffering.
The legal risk was too high.
The legal risk was too volatile. By strategically shifting focus in 2015, the company was able to leave behind a segment that was notoriously fraught with regulatory and legal challenges. They essentially traded the legal volatility of a $37 million bad faith judgment for the logistical volatility of mobile device repair, a risk that is fundamentally quantifiable and controllable.
It becomes incredibly clear that the great pivot of 2015 wasn't just about finding higher growth potential in niche segments. It was a strategic mandate to de-risk the entire enterprise from the specter of massive bad faith judgments tied to life-altering illnesses. They chose B2B specialty risk management over complex, consumer-facing, high-liability medical risk. #outro. As we wrap up this deep dive into Assurant, we've covered a journey that is truly remarkable. From the La Crosse Mutual Aid Association, a regional mutual aid group in Wisconsin in 1892, through decades of international conglomeration under AMEV and Fortis, including a major IPO in 2004, culminating in its current form as a global, publicly traded, specialized risk management corporation.
And the defining action of this entity was the radical, decisive shift between 2015 and 2016. They fully moved away from life and health insurance, sectors that had been a core part of their history for over a century, and bet heavily on two highly specific types of risk.
Global housing.
Dominated by the B2B relationships of lender-placed insurance.
And global lifestyle.
Defined by specialized device protection and extended warranties that require global logistical expertise.
They executed a complete corporate DNA transformation. And critically, they successfully walled themselves off from the regulatory and legal challenges that plagued their former health division, escaping the perpetual risk of those massive punitive judgments we discussed.
And that strategic specialization fundamentally changes their operational stability. Specialty insurance, like LPI or mobile device coverage, differs fundamentally from major medical insurance.
It's all about predictable risk.
They are dealing with predictable risk models. When a phone breaks, the risk is quantifiable and the loss is finite. It's the cost of repair or replacement. When a customer develops a long-term chronic illness under a traditional health policy, the liability is potentially immense and subject to intense legal and regulatory interpretation. This specialization appears to be the core, stable strategy going forward, relying on data and logistics rather than navigating the ever-changing landscape of human health legislation.
So we leave you with one final provocative thought for you to mull over. Given this company's incredibly long history of constant mergers, acquisitions, and strategic divestments, the relentless need to shed old business models, how stable is the current definition of a specialized insurance giant? They are now betting big on the global lifestyle segment, which is inherently tied to consumer electronics. Will the lucrative but volatile market of mobile device protection and extended warranties, which are themselves susceptible to rapid technological change, obsolescence, and shifting consumer loyalty, demand yet another major radical pivot 2 decades from now? Will the constant evolution of digital devices and the eventual saturation of that market force this specialized giant to shed its current core business, just as it shed its traditional core business a decade ago?
It's something vital to consider as you think about how this financial behemoth quietly manages the invisible risks around your everyday expensive products. The history of Assurant shows that today's core competency is tomorrow's liability waiting to be divested.
We hope this deep dive has given you a shortcut to understanding this hidden giant of the modern financial world and the powerful strategic calculus that drives corporate specialization. We'll see you next time.